Creamer Media's Mining Weekly is speaking to Mark Gilbert of Shallow Reefs Gold, a company that is aspiring to mine the historical reefs of the Witwatersrand Basin. Mark, can you give us an update on how things are going with this Shallow Reefs Gold?
Martin, we're in an incredibly exciting phase right now. We've been very active in the capital markets, and I'm hoping that in the next few weeks we'll be able to announce a fairly significant capital raise out of North America into Shallow Reefs Gold. And I think it's worth just maybe recapping for a minute what our strategy is here. And I use the analogy all the time that in many respects we have the curse of plenty in South African gold mining. You know, we've been so used to these 60, 70, 80 million ounce ore deposits in the gold sector and platinum sector for that matter, that we tend to view smaller deposits, 1 million ounces, 2 million ounces, 3 million ounces as not worthwhile. Yet if you go anywhere in the rest of Africa, if you were in Ghana, for example, and you found a 2 million ounce gold deposit, you've got a listed gold mining company. So, you know, what's transpired over the last few decades is the majors and huge amounts of capital committed to these ultra deep level mines. And it of course makes commercial sense to continue those. But we are literally blessed with this plethora, and I use that word, across the entire Witwatersrand Basin of these smaller deposits. And we're looking for mineable resources of 1 million ounces upwards. And again, to put that in perspective, there's only a few hundred gold mining companies in the world with 1 million ounce deposit or bigger. We saw one in Nevada the other day, a 400,000 ounce gold deposit listed. And, you know, that was a $200 million company. So we're progressing very well. The capital raise is progressing. We have some very significant backers out of North America. Our target pipeline has been sharpened a fair bit over the last while. There are 5 initial projects that we are looking at where we've been in conversations with the owners. Some of them are the majors, as one would expect. Very positive conversations. But I think what's becoming apparent to us, most excitingly, and I think for all the challenges that are well known to us, is that South Africa is literally the cheapest place on the planet right now to buy gold assets. You cannot find quality gold deposits of the quality that we have in South Africa at the prices that we are seeing. And as I say, that's of course is a double-edged sword. You know, there is a lack of capital coming into the SA market, although I'm very, very pleased to say that we're seeing that trend change. We've been part of transactions over the last little while. We've seen very significant amounts of foreign capital coming into South Africa. And maybe just an expansion on that for a moment, even more excitingly, we are starting to discover, which will all be announced in due course, some mineralization in the shallow vits, very high-grade mineralization that was not apparent, let's call it, to the old-time miners who were very used to mining the traditional Wits conglomerate. Again, once we discovered gold was in the Wits conglomerate, we could literally just follow it, and we've followed it, you know, all the way to 4.5 kilometers underground now. But much like we discovered the carbon leader, you know, in the 70s and 80s as a very high-grade reef, we started to find some very interesting shallow reef deposits of similar mineralization, which are unbelievably exciting. So I think you will find us on the opposite end of a lot of people in South African mining right now. We're incredibly bullish. We're very, very excited about South Africa. We're hyper-focused in South Africa. We're not looking at a diversification strategy out of the country. We have an incredible portfolio, target list assets that, again, is just mind-boggling, the price that one can acquire them at. And we've got some very large development capital coming behind us who want to build a junior gold producer here in SA. And I think the last 2 key pieces of the story, which we discussed last time, still hold true. We have an enormous surplus of plant capacity sitting in the Wits, which is available. We've been tolling at one of our mines with one of the majors very successfully, very cost effectively. We're in conversations with 2 of the other majors right now on tolling arrangements, and they're incredibly open to it. We do know tolling arrangements, of course, have their challenges, but we've got a fair bit of experience in that space now. And then the most exciting bit for us is the liabilities on the rehabilitation. All the dumps are being swallowed up, or have been swallowed up by DRD Gold and Mine Waste Solutions. So those companies actually want our material. What we'll be producing in time will be insignificant compared to the dumps that they're sitting on. But, two of the biggest challenges for mining companies in Africa is tailings deposition and the liability associated therewith, and infrastructure. And both of those we have ready built, for lack of a better word, in close proximity to the assets we're looking at, which further reduces the cost of getting these assets onto the balance sheet. And maybe the last bit, our mining team that we've been assembling, we've been working very closely with a mining team and building that competency. The quality of skills in this country is just absolutely phenomenal. We are blessed. You need an electrical engineer to come and resolve a problem on your compressor. You literally pick up a phone. If you're sitting in the Congo or Ghana, the guys on an airplane from Johannesburg or Europe, or it's 4 days. Here the guy just jumps in his car and he's in his bucky and he's there in an hour or two. So we think the pessimism scale has swung way too far to the negative. And again, to use the old Warren Buffett analogy, be fearful when others are greedy and greedy when others are fearful. And we're very much in the greedy phase right now. We're very, very bullish gold mining and precious metal mining in South Africa. I think recent results from the listed gold companies and PGM companies back that up. They are quite literally printing money at the moment across the board. We've got a skilled labor force here with surplus labor, a weakening currency and a hard currency asset, and we've seen precious metal price appreciation. It's almost a perfect storm. And we're really trying to drive hard that the narrative needs to shift in South Africa. Yes, it's hard. Yeah, of course we know it's hard. We're not naive, but have you tried to buy a mine in Congo? I have. That's hard. It's no harder here than it is there, I promise you.
I just wanted to put a question to you about the legislative framework and the legislative environment. You seem to indicate that is not an obstacle at all. Are you able to get licenses, or how do you go about it?
We're incredibly fortunate there, Martin. We have a partner law firm, NSDV, which is a specialist mining and environmental law firm. NSDV have taken a very different strategy to law and regulators in South Africa for too long. And I'm very critical of the industry now, and I'll be vocally critical. You hear the same people saying the same thing the whole time. We need policy certainty, we need policy certainty, we need policy certainty. At some point, you have to say, we're not going to get it. Okay, so now what are we going to do? Do we abandon ship, or do we figure out how to play within the realm that we're operating in? NSDV have set themselves up in a very different way to the other law firms. They pride themselves on the relationship that they have with the regulators. There are a lot of competent people in the regulators. They're hamstrung, they're undercapitalized, under-resourced. And to be frank, they're tired of being beaten up with a big stick. And very often mining companies, in our opinion, they'll win the battle, but they lose the war. Because these are human beings at the end of the day. And after they've been hit enough, are you surprised that your Section 11 takes 6 years to process? NSDV pride themselves on holding those relationships and then, literally sit with the regulator, discuss the issues, ask the regulator for advice. So far, we've found it to be an incredibly productive approach. We have not seen any challenges. So the quick answer is yes. We are getting our applications, we're getting our water use licenses, we're getting our prospecting rights granted. Is it as quick and efficient as it should be? Of course not. But the risk-reward differential is so heavily stacked in our favor now as a country. When you look at, again, the price of assets that we can acquire, that's no longer a hindrance. It's a hassle, and it's stuff you've got to slog through. And again, it's easy to say it's stuff we shouldn't have to do. Well, again, at what time do you stop complaining and start to turn the narrative? I want to, if you don't mind, just add one thing there. In our opinion, we're in the early stages of a commodity super cycle. we've seen unbelievable price increases across large portions of the commodity basket over the last 12 months in a recession. Part of the reason is the wrong reason, as I think we spoke about before. It's monetary inflation and printing, and you're starting to see inflation ticking up in the US aggressively. I think their last print was 5.8%, which is above ours, which is pretty radical if one thinks about it. So we're a mineral-rich, blessed country. We have a deeply functioning court system and legislative environment. The rules are changing, and yes, it's frustrating, and we accept that. There are ways of protecting oneself in that contractually, and we've started to do that. So one can create structures where if there are change of law events, you have the capacity to restructure with your ownership deal, for example. Instead of just saying it's a massive problem, it's like, well, how do we solve the problem? We're blessed with a highly skilled labor when it comes to underground mining, highly skilled, rock drillers, engineers, LHD operators, etc. We've got unbelievable technical skills across the entire spectrum, engineering and others. We've got phenomenal mineral resources, processing capability. So the one thing everyone complains about is policy certainty. If I look on the list of kind of checklist of things one needs to start a mining company, and that's my biggest headache, bring it on. I was looking at the Kibali mine owned by Barrick up in the Congo. They had to build a 1,800 kilometer road to Kinshasa port to bring their materials in. It takes 2 weeks. You don't see them complaining, going, well, there's no roads here. Yeah, so again, just unbelievably excited in terms of where the sector's going, seeing capital flowing into the sector. We're seeing foreign capital flowing into the sector, which is a wonderful thing. Our investors, we phoned them during the riots and said, just, heads up, you're aware what's going on. And they were like, are the mines affected? No, it's fine, let's go. Really looking at it, ultimately that stuff puts pressure on the rand. It improves mining. You look just north of the border at Zimbabwe, an economy destroyed. What's still operating? Well, their mining industry. They're mining diamonds, gold, PGMs, chrome. We just do not understand the doom and gloom around the South African mining industry, and it's a boon for us because people are offloading assets that, in our opinion, they just shouldn't be selling. But one has to be savvy, and one really has to be savvy. The vast bulk of the capital coming in is foreign capital. So if you don't have strong hooks into foreign capital networks, you got to work with people who do. The right corporate finance advisors, because the domestic capital markets on the debt side is fine. You'll raise plenty of debt here from the banks and others. It's the equity checks that are challenging, and almost all of that's coming out of, from what we're seeing right now, Europe and North America. But huge amounts of support. I mean, the commodity market is absolutely booming over there. And you just follow the money, the old adage, 75% of the world's mining capital comes through Toronto. So, if you're not talking to the Canadians, you're missing, 3/4 of the global capital flows, which is where most of our capital is coming from, interestingly enough, is out of Canada. Policy, certainty, uncertainty, concerns, it's a challenge. Mining is a challenging industry. On the list of problems, I wouldn't even put it in my top 3.
And is the JSE still out of the question as a listing destination?
It's a good question. I'm going to give you the typical Afrikaans saying, ja, nee. We will be listing, and we'll be listing in Toronto as the primary listing. We will certainly secondary list in South Africa, because what we find, and again, it's a great shame for South African mining. We've lost all of our early stage capital investment. There's just no one who will back someone like us, notwithstanding the skills, the team, the history, the knowledge. But where the South African funds, pension funds and asset managers do come in play is when you've got a sort of 2 or 3 year track record. And we've seen significant, I was looking at some of the statements. I think Alan Gray is a 25% investor in Pan-African. So they're heavily exposed to South African gold mining, underground. They're building Evander right now. But they've got that track record. So no one's willing to back the early stuff, which South Africa was unbelievably well known for, in the early 1900s. We were the destination for mining capital as a country. But yes, one does need to be listed on the JSE. So we will inward list onto the JSE when appropriate. It probably won't be, in the first year or two, because the first year or two of these assets is really bringing them up to definitive feasibility stage. So that's the first 2 years of the project. And then it's the production capital. We will definitely list on the JSE, but not as a primary source of capital. It will become a big secondary source of capital once we're up and running. We hope so, as it has for all the other mining companies.
And how much capital are you required to raise?
So the first raise is $21 million. So this is called 300 million Rand. So that's the seed round. What that allows us to do is to acquire and finalize the definitive feasibility study on the first 5 projects. Now, again, we're not naive. Not all 5 projects will reach, definitive feasibility conclusion or satisfactory conclusion. Although, as the gold price keeps ticking up, that becomes more and more likely. But that's the first round out of our investors. We're then looking at the development capital on the various projects. Because remember, unlike the big mines, we're not building one big mine. So, we're going to be running a portfolio of, 3 or 4 or 5 smaller mines. We're looking at production of between 50 and 80,000 ounces per annum. Again, quite different to the mines that are currently in existence. Almost all of them are trackless decline. So, the stuff that's been very well deployed on the Bushveld complex by the PGM miners. There is one asset with an existing shaft in it, and the ore body's at 340 meters below surface. So, that works very, very well. But the capex for putting a trackless decline in is dramatically lower than a vertical shaft. You're looking at roughly 30%. With the additional benefit that as you're sinking your decline, you have access to the ore body. You can start mining. Unlike a vertical shaft, you've got to put it all the way down, put all your haulages out, equip them before you put your cables up. We've been looking at trackless decline mining. We won't be the first gold mine doing it. Obviously, Modder East is sort of the poster child for that. Run very successfully initially by Neil and now under kind of Gold One control. It's been deployed very successfully in the Bushveld. It's been deployed very successfully in the Wits by Gold One, Neil Froneman. So we're copying that. We really are copying that model. So the capex per project is going to vary. And again, we largely are only building the mine. We're not building the plant and tailings, building in proximity. So we're looking at capex checks of the order of sort of $40 to $60 million to put a mine into production. Again, you look at that and you go look at it on any global scale. I mean, there's almost a stunned silence on the other end of the phone. It's, are you sure? Like, you're not missing something here. And the answer is no. Again, because I'm not sinking, R1 billion into a new plant and building a tailings facility, which is going to take you 3 or 4 years to license. All of those things are taken care of. So depending on the outcome of the DFS, we'll look to put the first mines into production, and we'll then probably be looking at, let's assume 2 or 3 of them go into production, $100 to $150 million raise. And that's total capex. The equity check is a smaller proportion of that. Let's assume half. So $75 million equity, the rest will be on project finance. Being in extensive conversations with the lenders in South Africa, there's a lot of appetite for the lending if the equity's there, which makes sense. We've got a trapped pool of Rand capital as a result of exchange control that needs to be deployed. So the debt is really not a concern. We're seeing quite big debt facilities going into mid-size mining companies right now. And in how many provinces are these 5 assets scattered? So the Wits, as we know, sort of runs over Gauteng, the Free State, I think it touches on Natal, running up to Mpumalanga, Limpopo. So the assets at the moment are largely Gauteng, and Northwest. So it's it's a hodgepodge, but they're all in the Wits bar 1. I think that's probably a better positioning statement. They will all be on the eastern and western Wits lines. That's where the portfolio, as I said, bar 1 asset, which is up in the Pilgrim's Rest, Barberton, Greenstone belt. that we're finding quite interesting. So, where the Pan-African guys are operating at the moment. As long as it ticks all the boxes, but we substantially expect to be a Wits gold player. That's really where we see the bulk of the deposit. And we have a list. I think the list is now at 17 additional targets. So, data we've compiled over the last decade. We've picked 5 assets that, from a regulatory point of view, are properly licensed, mining rights in place, good drill data, proximity to infrastructure. So we went through a selection process in kind of weeding out. We won't end up with the resources that the majors have got, 100 million ounces, 200 million ounces, but I think the value that is ascribed to those by the market these days is relatively small. A lot of it is deep, a lot of it's difficult to get to. I think a 20 million resource, of which a substantial portion of that will be mineable, convertible into a mining reserve over time, is a very, very attractive proposition. At 10 million ounces, 200,000 ounces per annum, you've got a 50-year life of mine. It's beyond any sort of cash flow modeling that any investor is going to do, with some decent upside optionality on the gold price. The two are intimately linked. But the investor base is very bullish gold. We're seeing sentiment turning very, very bullish gold and PGMs right now, and I don't see that changing anytime soon.
And will you take your ore to concentrate and then give it to different smelters?
No. So in the gold space, and it's the perennial toll treatment challenge, but the way most of the gold plants are set up is, they're big. You're looking, most of these plants are 160 to 300,000 ton per month, which is way in excess of what we'll be producing. We're looking at our mines producing 40 to 50,000 ton a month. But they set up with a bunch of different milling circuits. There's a crushing circuit and a milling circuit, often sort of in parallel, 4, 5, 6 circuits. And those big SAG mills have a 30, 40,000 ton per month capacity. So what we really would like to do is to get a dedicated mill at one of the plants. The benefit of that is the only material going into that mill is yours. That. What comes out of the mill into the underflow thickener is a homogeneous, ultra-fine material that can be sampled very accurately. And then it obviously gets commingled with the rest of the material going into the plant. But from a metal accounting point of view, we've got a very accurate measure of the gold that we pushed into the plant. And again, we're doing this with one of the majors right now, and they're fantastic. We've got good visibility of the metal accounting data. We do suffer the plant recovery factor, and it does fluctuate depending on the material they're putting in. But for the most time, it's running up in the the early to mid 90% recoveries, which is maybe marginally worse than what you would get building your own gold plant. But the benefit of not having to spend that capex and converting that entire cost into an operating cost is just orders of magnitude more valuable to us. Depending on the location of the assets, in the fullness of time, we may actually look to buy one of the plants, the dormant plants. Gold is what they call hydroscopic, is it follows water. So over long periods of time, as these gold plants operate, the gold leaches into the walls and into the foundations, and they become super enriched with gold. So one of the last things the mining companies do when they tear down a mine and a gold plant is they strip all the metal out, sell it for scrap, effectively break up the concrete, crush, mill, and put it through another gold plant, which is a lot of the reason these things haven't been thrown away yet. But if they're going to scrap it, you can effectively, it sounds odd, but you can actually drill the concrete in the walls. You can generate a resource statement the same as you would on a reef. And you can pay the company for the embedded gold and the scrap metal, and effectively you own a plant, because that's really its only value to them. So you're looking at buying, these are huge plants that, 40, 50 years ago in today's money would have cost 3 billion rand to build, and you may be picking them up now for a few hundred million. And there's just so many more benefits to that. The plant has bedded down. These plants are, I always like that they're organic things. It's a mechanical plant, but it's got its own heartbeat and ebb and flow. And, not every gold plant works exactly the same way. So to be able to buy a plant fully licensed, powered, bedded in, so to say, is an enormous advantage again. The older plants are actually really valuable. They, all the teething problems have been kind of kinked out, and all the skills, all the guys who ran those plants are still available. It's incredible. I mean, we spend quite a bit of time with the older generation in retirement now, and the experience and knowledge that those guys have on these plants and assets, it's just incredible. It's like sitting and listening to a history book at times. I love it.
And finally, will you refine at the Rand Refinery?
We shall. The good old Rand Refinery. Absolutely. So, once our gold leaves the mill, it clearly then gets commingled, with the gold of the major or the plant owner, and all of them sell their gold to Rand Refinery. And even if we owned our own gold plant, we would sell it to Rand Refinery. That system works so unbelievably well in South Africa, Martin, for two reasons. One, the refining costs are negligible. Rand Refinery doesn't charge you for refining as a mining company. They really make their money on stamping coins and memorabilia and things like that. And their second big business is obviously custody, is holding gold in vault. So the reason Rand Refinery is so well guarded is it is one of the bigger gold depositories in the world, part of the London Metal Exchange. So there's a huge amount of bullion sitting at Rand Refinery. But because they're part of the LME, your refining costs are low. They sell the material into the LME. You get paid in 48 hours from a AAA rated balance sheet. So we get these inquiries all the time from all over the world. We want to buy doré, or we want to buy physical gold. So, okay, are you willing to pay spot plus 20? And they have a heart attack. No, I want to pay a discount. Well, why would I offer you a discount if I can sell it to Rand Refinery at market and get paid in 48 hours and have someone collect it in a helicopter? I don't need to worry. You can go to South Sudan and buy at a discount, from the artisanal miners, but not in South Africa. Because if I sell it to anyone else, I've got to take all the payment risk, the paperwork, the insurance, the assay processes. It's just not worth the headache. Which is why all the majors continue to send to Rand Refinery. It's one of the most efficient refineries in the world. And again, it just talks to the base infrastructure that we have here in South Africa. It's incredible. One can, interesting enough, once it lands at Rand Refinery, you can always buy the physical. And if we wanted to hold, we've had some conversations. We're so bullish gold. Should we not actually hold some of our cash reserves in time in gold? We probably would. But you'd hold that at Rand Refinery itself. Not in your backyard.
That was Creamer Media's Mining Weekly, speaking to Mark Gilbert of Shallow Reefs Gold.